We're going to go ahead and get started as people continue to join. Thank you to everyone who is joining our webinar today. My name is Angela Griffin, and I'm trying to fill some big shoes today. Courtney Yaki, who normally leads these monthly webinars, is attending a conference, and so I guess I'll be pinch hitting in the spirit of spring training. So I'm with Coles Together, which is the economic development organization for Coles County, but I'm also part of the Business Navigator Alliance of Southcentral and Southeastern Illinois. And it's this alliance made up of me and several of my colleagues, and you can see another one on the webinar, Risa Shaner. It's this alliance that puts on these monthly webinars, which typically are held on the last Thursday of the month. So I put that out there for your future planning purposes. My colleagues in the Navigator group include Lori Miner with the Sullivan Chamber and Economic Development Office, Risa Shaner with the Crawford County Development Association, Nora Swalls with the Marshall Area Chamber of Commerce, and Bob Colvin and Freddie Schmuddy with the Paris Economic Development Corporation. And then, of course, our leader, Courtney Yaki with the Effingham Regional Growth Alliance. Many of our members are attending the Rural Affairs Conference, and so that's why they're not with us today. So today's webinar is an overview of the state of Illinois' small business loan programs and its venture capital program. Some of the loan programs have been around for a while. And not only have they been rebranded and tweaked, but there are also new programs available for Illinois businesses. So it's going to be worthwhile to learn all the latest information and the latest programs that the state has available for us, whether you're a business owner joining us today, or you're a lender joining us today, or you're someone like me whose job it is to connect small businesses with Illinois resources. In fact, that's the mission of our Navigator group, which represents a 6-county region. And that's to link businesses in this region with resources that can help them be successful as we're all still trying to navigate the landscape and come out of the pandemic stronger and growing. So our first speaker today is Donna Ewan. Donna started her career in government with the city of Chicago. She's also held roles with Cook County, with Chicago Not-for-Profits, and with a global consulting firm of Oliver Wyman. Most recently, Donna was with 7 Wire Ventures, an early-stage digital health venture capital firm in Chicago. In her current role as venture capital program manager at DCEO, she's responsible for managing $114 million in the Illinois Innovation Venture Fund, or INVENT. So welcome to our webinar, Donna. Thanks for joining us today. I'm going to share my screen and let you get started going through your presentation.
Awesome. Good morning, everyone. And just so everyone knows the format of today, we'll hold off questions till the very end. Is that correct, Angela?
That is correct. Thank you for reminding me of that. Yep. And you can put your questions in the chat and we'll go through them at the end after both Donna and Sean present.
So today we'll go over an overview of our fund, the investment lens. Next slide is fine, Angela. We'll go over the investment lens, our general eligibility, our process, and then I'll also share some resources that our department has. So INVENT is the Illinois Innovation Venture Fund, a $114 million fund that invests in early and late stage companies through a direct investment in exchange for equity ownership. This is not a fund of funds where the fund manager invests the capital. We are looking at companies directly and reviewing with the company to make that direct investment. The program is funded through the U.S. Department of the Treasury State Small Business Credit Initiative, known as SSBCI for short, and administered by our department. The purpose of the fund is to really support founders and companies that have lacked access and exposure to venture capital funding. Raising venture capital funds is traditionally relationship-based with significant barriers to entry. So we're really trying to help address that gap. So our focus is on the 7 key sectors that have been identified in the Illinois Economic Development Plan. We're focused on supporting companies in these sectors. Next slide. However, the purpose of the fund is also to support companies, businesses that are owned by socially and economically disadvantaged individuals, SETI for short. This is a term that is defined by the U.S. Department of the Treasury. And in addition, our department had expanded on the definition by creating 2 additional groups where a company can certify as having difficulty in reaching or in fundraising because of characteristics that fit under these categories. And the key thing to note here is that if a company certifies as SETI eligible or capital disadvantage eligible, that means we would be industry agnostic. So if you're in a space that is if you're working on a technology company or a finance technology company, and that's not listed as a economic development sector, we will still consider the company for an investment as long as the company certifies as SETI or capital disadvantage business. So on the next slide, we share a little bit of the definitions or the characteristics where a company can identify as SETI. These are all outlined on our website as well, and these are developed by the U.S. Department of the Treasury. So some highlights could be that the business is located in a community development financial institution investment area, or more than 51% of its founders fit some of the circumstances that are listed in the bullets here. On the next slide, we should group the characteristics that fall under the capital disadvantage business. And the 2 groups are disproportionately impacted area, where business certifies that it has lacked access to capital due to operating in or residing in some of these areas. The last group is the historically underrepresented group, where a business certifies that their capital has been diminished due to the majority of their owners meeting some of these characteristics. And there is overlap between SETI and capital disadvantaged business, and we understand that. There isn't an extra bump for meeting more or less. This is a self-certification, and the idea is that if a company is categorized as such, then we would be industry agnostic. If a company does not choose to certify, then if it fits within one of the 7 key economic development sectors, they're also eligible for potential investment. Next slide. So the type of investment can be in the form of preferred and common equity agreements, a SAFE, which is simple agreement for future equity, or convertible notes. Our check size will range from $10,000 to $6 million. We don't plan to do too many $6 million checks, but this is the range in which we will consider an investment. Next slide, Angela. General eligibility. So a fundraising round must not be more than $20 million. This is a Department of the Treasury cap. And so if you're raising outside of that amount, then unfortunately, this program is not for you. The other eligibility requirements is that the company, including its affiliates, is under 750 employees. The company must be in good standing with the Illinois Secretary of State. Its principal place of business is in Illinois, and at least 51% of the employees are also based in Illinois. The company must be structured as a C corporation. We will meet with companies that are a limited liability company, but before that company proceeds with the rest of the diligence process, that company must be a C corporation. And we're looking for businesses that are looking to, has potential to increase jobs or capital investment in Illinois. We also understand that there will be some companies that may have a lot of its employees in Illinois already, and but they are headquartered in another state. And so for those companies, we will consider an investment as long as that company moves its principal place of business to Illinois within 2 years. But at the time of investment, the company must still have 51% of its employees already based in Illinois. An investment from the event fund requires a private capital match. This is to emphasize a public-private partnership where we will not be able to invest without leveraging a one-to-one private capital dollar. And so this is not to say that we are planning to invest 50% of a round. This just shows that we won't be able to participate in a fundraise without the private capital involvement. And that private capital match must be an investment entity, such as a venture capital fund, angel fund, family office, investment partnership, or an LLC. It could be a venture arm of a corporation, an organized investment syndicate, a CDFI fund, or an accredited investor. Funds raised through crowdfunding platforms, 401ks, IRAs, personal vehicles, or other government funds such as grants are not acceptable private capital match. Next slide. So how does the process work? If a company is interested, the company will submit an expression of interest form that's available on our website. The team will review the general eligibility items and meet the company to further discuss the business. We take a look at a variety of factors, including the investment stage, the founding team, business model, market opportunity, financials, and impact in Illinois. The team will then review the companies with an internal investment committee and our director for final determination. Next slide. So that wraps up the program itself. I wanted to share some other resources that are available to businesses that the department offers, such as the Angel Investment Tax Credit Program, which helps companies that are fundraising. If a company is qualified for this program, its Illinois investors may be eligible for a tax credit equal to a percentage of their investment. The other program is the Economic Development for a Growing Economy, known as EDGE program, which offers tax credits to the business. If anyone is interested in learning more, our website has additional information on these programs. Next slide, please. In addition, there are also grant programs where if a company has already received a federal SBIR, STTR grant, they would be eligible to receive a state match up to $50,000. The other resource is on our website. There is a grants section that is updated regularly where you can take a look and see if there may be a grant that's applicable to you. And finally, on the next slide, there are loan programs available. And so I will transition this over to my colleague, Sean, to talk us through the loan programs.
Okay, perfect. Thanks, Donna. Angela, are you
Sorry.
ready for me to go ahead and get started?
I hate to interrupt you there for a second, Sean.
No, that's okay.
I just wanted to give an introduction, a little bit about Sean's background. So Sean is the Advantage Illinois Financial Review Manager with the Department of Commerce and Economic Opportunity. He oversees the Advantage Illinois Loan Participation Program, or the PLP as some may refer to it, and the new upcoming Loan Guarantee Program. He works with lenders and small businesses throughout the state of Illinois. He joined the DCEO team in February of 2020 as the Assistant Deputy Director of Business Development. He's worked on small and large economic development projects and business development projects. He's worked in business attraction, with tax incentives, and with business loans. He came to the state from the private sector, including working at a nationwide insurance company as head of special projects and in banking and business and development. So Sean, I will turn it over to you.
Yeah, thank you. Good morning / into the afternoon to everybody. Thanks, Angela, and thanks, Donna. But yeah, so we're here to kind of talk about, not only the Advantage Illinois brand name, but also the two programs that fall beneath that. So that is, again, as Angela just mentioned, it is our participation loan program and then our loan guarantee program. And then we'll round it out just kind of talking about the Illinois Finance Authority, how they have a loan program called Climate Bank. So Angela, next slide, please. All right, so we're going to start off by talking about the PLP. Again, that's the participation loan program. Out of what I'm going to be talking about specifically, this is our most longest standing program when you kind of refer to or think about low interest / loans to small businesses. Advantage Illinois been around since roughly 2010, kind of starting doing loans back in 2012, and then it's been operational ever since. But what really is a participation loan program? Essentially, it's a program that helps, again, small businesses get term loan financing at lower rates. We do this by purchasing a portion of that loan directly from the lender. So we're kind of really more or less working with the bank side, but it's really kind of helping your access to capital and some things that Donna mentioned that we'll cover again. But our goal here at the state level is really to help those businesses grow, expand, and create new jobs in Illinois at a faster rate. Next slide, please. So Advantage Illinois really is designed to help fill in gaps that you may or may not have as a small business. A lot of it we refer to as kind of the lender or the banking rationale. Why does that bank have any concerns? How does your business maybe not fit into those banking policies? And then how can we subsequently assist with that? A lot of the times what we see really at the top of your screen, which we're about to cover, that's our most common rationale or items that we're assisting with, but it's businesses or owners that are having collateral and or equity shortfalls. So if your collateral is just not enough, maybe the bank, you're not meeting that bank policy, or you don't have enough equity. Equity is just that kind of cash or that deposit down payment, essentially, that you're putting into the loan as well. Additionally, we see what's called lack of historical cash flow. If you're a startup business, in the lending environment or in the lending industry, startups can be more risky because there's not financials that the bank can kind of look to and see what has your performance been. We see a lot of low credit scores. We actually do not have a minimum credit score within our program. However, again, lenders may have scores that they like to see, all across the board. And then additionally, we do see a lot of not only businesses, but the business owner or owners with negative net worth. But the loans can be used for real estate acquisition. If it's a kind of a building that's already in existence, you're just acquiring it, purchasing it, renovating it, then it must be 51% or more occupied by the business. If it's a brand new construction, you're looking, you found a parcel and you're going to build this up, then your business must occupy 60% of that business. The loan can be used for inventory, working capital, equipment, leasehold improvements, and accounts receivable. It doesn't have to be used for all 6 of those items I just mentioned. It could be for one, or it could be for multiple. For example, you may have a project where you're looking to purchase a new building, but then also you need to purchase some new equipment to go into said building. Maybe you need some inventory as well. So that all becomes what your project is. We do offer refinancing. We work with lenders on that. There's some caveats. You see some at that kind of bottom right to the screen there. a couple caveats, if it's an unrelated lender, that loan or that refinance cannot be used to finance an extraordinary dividend or a distribution. So essentially you couldn't, as a small business, look to take out one of these Advantage Illinois loans to pay like shareholders, like a benefit or a bonus, things of that nature. Next slide, please. The benefits of Advantage Illinois to you, the business, it's helping with that access to financing or that access to capital, providing lower rates. To the lenders, our banking partners, it's allowing them to do more loan volume with less risk. And then for us here, we already mentioned it briefly, but it's assisting with that economy growth and then as well as the job creation and retention. And then some important information for the participation loan program is in most cases, we are subordinate to the bank. Essentially what that means is in the event that unfortunately your business may go under, whether that's bankruptcy, foreclosure, et cetera, we take a step back and we allow the bank to try to recoup as much money as they can before then we see a penny. So that really, really does help the banks to be able to offer these loans with us. There are no Advantage Illinois term loan fees for the borrower or for the lender. You see the asterisk there, lenders can still charge their normal fees. You're just not going to get additional fees on top of us, or on top of that from us, excuse me. That may be, lenders might charge like a loan application fee, origination fee, things like appraisals, lien filings, things of that nature. That's still okay, but like I said, you're just not going to get any additional fees for us. Our documentation application process is short and simple. We don't actually have what I would consider an application packet. We call them exhibits. So for the borrowers, if you're looking to take part of these loans, you'll have a few exhibits for us to fill out, to certify and to complete. Won't take you but 15 to 20 minutes, and we can work with you just on any questions you may have. On the opposite side of that, we work directly, and really a lot of our customer base is really more the bank level, because that's who we're working with on like these loan reviews, making sure that we're able to approve said loan. And that's what you're seeing at the bottom left. So we use or piggyback off of our banking partners. So once you've completed an application with them, they start their underwriting process, and then they send that information over to us. And then we do have a document, what you see at the bottom right. It is called an ITR-1. It's a document that you have to fill out for the business and any business owner that owns 20% more. But it's a document that goes to the Illinois Department of Revenue just to confirm that there's no back taxes that are owed. Next slide, please. The types of financing that we offer / have with Advantage Illinois PLP is broken up into two categories, standard and then SETI. You did hear Donna already reference SETI. A lot of that is the same stuff. A lot of her compliance and guidelines from U.S. Treasury are the same guidelines that we have for this program as well. So you'll see some common familiarities between Invent, Advantage Illinois, Participation Loan Program, Loan Guarantee Program, as well as the Illinois Finance Program we're going to talk about momentarily. But for standard, that's any project or business that does not qualify for SETI. We can participate the lesser of 25% of the project, 50% of the loan, all the way up to $2 million. We can go out 7 years, and our interest rate on our portion of that loan is fixed at 2% below the bank. So if the bank is at, let's say, 8%, we're going to be at 6%. So you as the borrower, you would then have something called the blended rate. That's just how much you're paying each month. It's going to help your money go further as that consumer, as that borrower. And then we do have a job creation and retention requirement for each $50,000 that we participate in. One full-time job should be created or retained in the next 2 years. Now, if you're a SETI borrower and you certify that again, you qualify under SETI, then we can do the lesser of 50% of the project, 50% of the loan, all the way up to $2 million, same 7-year term. The rate, however, is fixed at 2%, very low, especially in today's rate environment. And then that job creation and retention just slightly adjusts, but it's for each $65,000 that we participate in. One full-time job should be created or retained in the next 2 years. Next slide, please. All right, getting into the loan guarantee program. As Angela mentioned, this is a new program for us in the state of Illinois. We're very excited about this. This is going to be another tool in the tool belt, so to speak, not only for businesses that are needing assistance, but also for our lending partners. But what is a loan guarantee? It's a program that provides a guarantee of partial repayment if a loan goes into default. It mitigates risk for private financial lenders. And then the same common goal is to help businesses grow and expand and create new jobs in Illinois at a faster rate. Next slide, please. The loan guarantee, again, common similarities here, can still be used for the same purposes that you saw the PLP. It can be used for real estate, inventory, working capital, equipment, leasehold improvements, and accounts receivable. So same type of use. Next slide, please. Okay, so the benefits and important information for this program comparative is the loan guarantee does help secure financing for a borrower who, as we've mentioned, is having a hard time or is unable to secure that loan themselves. You know, we kind of talked about that the participation loan program has no fees. The loan guarantee does. It does include a loan origination fee and an annual guarantee fee that we charge the lender. The documentation process and application is still very short and simple. It's still those same exhibits that I was referencing before. And then we still do piggyback off of, you know, our lender and our partner there, just on that review and that underwriting process. Final quick note before we switch slides. You see that asterisk, and then at the bottom, just quick note. Any fees that we do charge the lender, we have caps and we have fee sets that are set by the U.S. Treasury. So they kind of go by the minimum national customer protection standards. So that's just to make sure that, again, that anybody that does these projects with us and these loans, that you're not taken advantage of with extreme high rates. Next slide, please. All right, so the types of coverages, very, very familiar. We offer two. We offer for standard. So again, that's all businesses that do not qualify for SETI, but our minimum guarantee is $10,000, and we'll guarantee 50% of the loan all the way up to $2 million. Same common concept, 7-year term. We offer coverage options, which you'll see on the next slide. The rate, that's negotiated between you and the lender. We don't do anything with rate in this particular program, but we still do have that same job creation and retention ask. For each $50,000 that we guarantee, one full-time job should be created or retained in the next 2 years. Then segueing over to the SETI side, again, you kind of see same familiarities. Again, I know I keep using that word a lot, but minimum guarantee of $10,000, maximum guarantee is the option, 75% of the loan up to $1 million, or 65% of the loan up to $2 million. Same 7-year guarantee term, same coverage options that you'll see on the next slide, and then same job creation and retention ask. It's the $65,000 guarantee. One full-time job should be created or retained in the next 2 years. Next slide, please. These are the two types of coverages that were, again, referenced on the prior slide, but within a loan guarantee or in a guarantee type program, we are offering two choices. One is called a first loss, and then one's called pro rata. But a first loss essentially just means that the losses of the loan are covered by Advantage Illinois and the limit. This is more for the banks. I know if we have any banking partners on today's call, this will probably be more of a conversation for like you and I. But for the borrowers, business owners on the call, don't pay too much attention to this slide until maybe we've had a chance to talk, understand kind of what your needs are, what you're looking for, because it's not supposed to be designed as a one-size-fits-all. That's why this new loan guarantee program is nice, that we now have options or alternatives. But essentially, I want to just really highlight the fees. So for the first loss, it's slightly more expensive because we, at the state level, we're kind of providing more risk aversion. So we're taking more on our shoulders, so to speak. So that fee is slightly higher. So the origination fee will be 3.25% of the guaranteed amount. So if it's $1 million guarantee, then the fee to the lender would be 3.25% of that. We'll have an annual guarantee fee. So every year that this coverage is renewed, the lender will pay 3/4 or 0.75% of the principal balance for non-SETI borrowers, and then 1/4% of the principal balance for SETI borrowers. So again, if you're a SETI, you know, your money's kind of going a little bit further there. And then the subtle difference that I really say is pro rata. That really means that the DCO side, you know, myself, we're working with the bank on sharing that loss. So unfortunately, if your business were to go under, rather than us just cutting a check to the bank and saying, hey, here you go, we're kind of working with them to say, all right, hey, here's a little bit of money now, here's a little bit of money now, here's a little bit of money now. So that's why I said, again, don't get too intertwined into this particular slide if you're a borrower. This is, again, more for if we have any lenders or lending partners on the call. But again, origination fee, 2% of the guaranteed amount. Annual guarantee will be 0.5% for non-SETI, and then 0.25% for SETI borrowers. Next slide, please. Now we're going to start slides that are the eligibility for both programs. So not only for participation loans, but for the loan guarantee as well. Our eligibility must be less than 750 employees, must operate in the state of Illinois, be in good standing with the Illinois Secretary of State, clear of any back taxes. I don't know if you can recall, a couple slides ago, I mentioned the ITR1 form that goes to the Illinois Department of Revenue. That's what this is referencing, clear of any back taxes. And then as well as for the borrowers, as well as the business, no bankruptcies, judgments, or liens in the past 5 years. Next slide, please. What's not eligible: goodwill, adult entertainment, investment real estate, wholesale, commerce of tobacco, gambling. We have an asterisk, so I'll talk about that in a moment. Cannabis, there are other programs available at the state level. Speculative investments and lending operations. And then finally, lobbying or political contributions, sorry. But for gambling, gambling can be permissible. So if you own, let's say, a restaurant, you own, let's say, like a mini mart, and you've got a couple gaming machines in there, that may be still okay, just as long as gambling does not eclipse 33% of your business's annual net revenue. Next slide, please. These are the SETI categories. Again, Donna's already mentioned some of these, but these are the different categories set by U.S. Treasury, as she mentioned, that if you're a borrower that you feel that any of these categories have impacted your access to capital and or diminished credit, then you would certify on one of our exhibits, and then you would qualify as a SETI borrower. Next slide, please. This is our Advantage Illinois team. Our team is broken out into obviously 2 locations, Springfield and Chicago. You can work with anybody on this slide. It does not have to be somebody in Chicago nor somebody in Springfield. That email address that you see is the easiest way to get in touch with our team, as all of our members have access to that inbox. But we can help you with any questions or try to help point you in the right direction. Next slide, and we'll kind of briefly go over the IFA Climate Bank, and then I'll give some more context about this program at the end. But the Illinois Finance Authority, they've received an allocation from us, DCEO, to provide participation loans to clean climate sectors. Very excited about this program. This fits a lot of not only kind of what Donna touched on, but Governor Pritzker's 5-year economic plan, but this also just kind of puts another tool in the tool belt if you're a borrower. And you'll see that here in a couple slides. But next slide, please, Angela. All right, so the IFA Climate Bank assists Illinois businesses that create or retain jobs by offering its program in conjunction with lenders. Same concept as us. It was designed as the state's climate bank as a directive to focus on reducing carbon emissions, create energy efficient programs, and provide equity and job creation. Their goal is to help accelerate the investment of private capital into clean energy projects. Next slide. Same concept, so I won't spend a lot of time on this slide. You can see, again, favorite word of the day, familiarity, similarity. It's the same U.S. Treasury guidance. So they're saying the same thing that I covered for my program. So again, I won't spend too much time on this slide. So next one, please. All right, so this is their eligible project list. So this is where I said, if you're a borrower and you're kind of in this type of industry, you're thinking of getting into this type of industry, this group will be great for you to meet and to have that conversation. But they kind of are looking at projects in the clean air and water projects, wastewater treatment, production, installation of electric vehicles, EV charging stations, which is obviously a huge topic right now as more EV charging stations get put out throughout the state, energy conservation, broadband expansion, etc. But you can see it's all across the board, going all the way from biomaterial production, all the way to clean climate generation, battery technologies, etc. So a lot of catch-all. The biggest one that I want to hit and why I saved it for last is what you see at the bottom left: production, installation, servicing of wind, hydro, solar equipment. So if you're a business that's looking to add solar panels, if you're looking to add a solar farm, if you're looking to do this type of stuff, this is a great program for you to take a look at. Next slide, please. Their types of financing, very similar as we've discussed, standard, it's same concept all across the board, except the rate. So if you can kind of recall, I said my program for standard was 2 percentage points below the lender. They're fixed at 2% regardless. So if the bank's at 8%, they're at 2%. For their SETI and what's called VSB, very small business, they offer their rate fixed at 1%. So even with my rates being low, IFA rates are even lower. It's a great way for you to do some of these smaller projects, adding to solar panels, et cetera, and really, really, truly making your money as the business go further. Next slide, please. This is the team for IFA. Evans Joseph is their vice president. He kind of oversees this program. I did not realize this, and this is truly my fault, that blue for the email kind of hits that background. So if anybody needs this information, please let me know. But again, Evans Joseph is kind of their manager, their person overseeing the program. And then Joanna Martinez Avina, she's on their SSBCI team as well. So both are contacts. If you work, I didn't put his name on here, but if you work with the IFA, and let's say in email correspondence, you see a name of Stan Luboff. Stan is on a contract working with the Illinois Finance Authority. He's working, kind of just helping them set up, making sure this program is successful. Stan actually started with DCO way back in the day and was the, I don't want to say ringleader, but he was the point of contact for Advantage Illinois when it first started. So Stan has a lot of experience, not only in Advantage Illinois, but in participation loans, and finally with U.S. Treasury, with kind of how they oversee and how they kind of expect these programs to work. So I did put him on there just because, again, he is on contract. He will be retiring soon, but definitely just wanted to let anybody know in case you see that name, that's who that gentleman is. He's wealth of knowledge. But all in all, that, 3 great programs. Happy to work with people. My final comment before I turn it over to you, Angela, is happy to answer any questions. I don't want anybody to think I sidestep them, but depending on the questions, Advantage Illinois, because our primary customer actually is the lender, the bank, will most likely point you back in that direction to start working with banks, and I can work through that with you, explain how that process goes. But we have found that a lot of successful conversations or positive conversations have been more one-offs or more kind of offline, understanding holistically your dreams, your objectives, what you're trying to do, and why you're trying to do it. But with that, thanks for the time today. Happy to see if we have any questions. And Angela, thanks for leading this, and I'll turn it back to you.
Thanks,
I think
Sean.
there we go.
Thanks, Sean. Thanks, Donna. Both great presentations. Yes, we do have a couple questions in the chat, and I would encourage anybody who has any others to throw those in the chat as well. I have several, so I'll let all of you put your questions in first, and then I'll hit them with mine. So the first question in the chat is, what support is available for financial institutions to participate in these programs? What are the biggest challenges for new loan participants for them to fulfill? So a 2-part question. What support, I guess, can DCEO provide to financial institutions to get them signed up as lenders? And then what are the challenges for the actual borrowers?
Sure, great question. To start with the first one, the support for the lenders is kind of all across the board, so I'll hit it quickly. Number one, their application process to become an approved lender with us is short and simple, and we can work through the process with them. Once they become an approved lender with Advantage Illinois, there are no quotas. So they're able to kind of look at these loans, see, how we can help them and kind of help move that needle. The additional support are kind of some things I briefly touched on. When you think about the participation loan program, us being subordinated, that takes a lot of risk off of the bank's plate. So in a lot of cases, it can help them. I don't want to say change their guidelines. That's a very misconstrued way to say it, but it can allow them to say, hey, we really, really like this loan. We really like this project. We really like this borrower. However, their credit score is lower than our bank policy. their equity is not enough. We need 20%. They can only provide 12. Their collateral is niche equipment. Maybe they're a manufacturer, and in the event of a default, we can't sell this stuff off at cost. That's then Advantage Illinois can help alleviate some of those concerns. So the program helps the banks out. There's a lot of support that this program offers. So hopefully that kind of helps answer that particular question. And then into the second part, Angela, just to make sure I answer this correctly, can you read that second part of that question one more time? I apologize.
Sure. What are the biggest challenges for new loan participants for them to fulfill?
Yep. Okay, so I thought that's what it was. I just wanted to confirm. So the biggest loan challenge is you have to find a bank. Due to it being a state program, we can't show favoritism by providing you with a bank initially. You kind of have to either look on our website or work with our team and we'll send you a list. But on our website, there's a list of active approved lenders that have gone through that application process. You can start with them. If you have a relationship with the bank that is not on that list, you can make an introduction or we can work with them and get them signed up. So it's very, very simple, but really honestly, your biggest challenge is going to be a bank because this program is not a direct loan program. Even if I think that you have the greatest project out there, I can't give you the loan myself. I have to have a bank do it with me. And that's kind of why I say, the banks really are customer at the end of the day, because you're going to be working with them on their process, and then they're going to be working with us. There are a lot of situations we can come in and we can help facilitate, we can help, bridge a gap, we can help answer questions or bring those groups together, but there's going to be a lot of one-off conversations. Because again, you're going to be working directly with the bank initially. And my final comment is we cannot make the bank approve the loan. So even if the bank sends it to us and we approve it, if they come back and something has changed or they feel like they do not want to approve that loan, while that is, trust me, an unfortunate scenario and an unfortunate event, we can't go back and make the bank do that. So that is really going to be your biggest challenge, is doing that, honestly. And I'm happy for whoever asked that question. If you would like to talk more about that, or if you have specific kind of thoughts behind that question, please let me know, because I'm happy to try to see if we can alleviate some of those concerns, or at least tell you, maybe what we could do, as like kind of the path forward, so to speak.
Great. While we're on that question, I did have a couple along those same lines before we jump to the other question in the chat. So you talked about collateral. Is there ever a scenario where the state participates in a loan where there is not enough collateral to fully cover your exposure?
All the time.
I know you probably move into a second position, but I'm just wondering if that's
Yep, all the time.
All the time.
Yeah.
Okay.
So this, and again, for everybody that's on this call and for those who are asking questions, please do not think I'm trying to sidestep any of these questions, but it kind of does go back to what I mentioned about the bank. If the bank is looking at your loan, it's called a risk. That is just flat out what it's called. It's called a risk. So when they're looking at your risk, and if they feel like they like that project or they think that we can help facilitate that approval, they're going to send it to us whether the credit score is a 580 or a 799. They're going to send it whether you can provide $100,000 of equity or zero. That's the same kind of conversation with collateral. We don't have a minimum per se, or we don't have a metric that says, hey, you're automatically denied because you are too far in the red or too far in the black. That's not really how this program is designed. It's really designed for looking at that exact thing. You've got a collateral shortfall, is what that's called. And that's okay for us, as long as you fit the requirements that we've discussed, as long as the project is eligible and it's for an eligible purpose. The collateral is kind of not a huge concern at all, especially from my side.
Okay, great, thanks. There's some other good questions in the chat here related to Advantage Illinois, but then also a couple for Donna. So talking about Advantage Illinois and the PLP loans and possibly also the guaranteed loans, what was the volume of loans approved in 2023? That's the first question.
Okay, so I'll get to brag a little bit. 2023, we broke every state record for loans. We did 149 loans last year. Some people might not think that's a lot, but that is an absolute ton of loans. 2023 was 149. The year before that, it was 95. The year before that, it was 51. And then in 2020, obviously, start of COVID, the pandemic, we did 16 loans. So as you can see, not only is the program ramping up with loan volume, but prior to 2023, 149 loans, as well as 2022, 95 loans, the previous high of loans in this program dating all the way back to 2010 was 67. So every year we're getting more lenders on board. We're spending more money. We have more assets under management, so to speak, than ever before. We have more loan volume that we've ever seen. And we actually have more applications coming in than we've ever seen. So that is just on the participation loan program, not even talking about the loan guarantee, which is brand new. So that's going to be a zero. But that's just specifically speaking that the past 3 years, we've done 351 total loans, which is pretty massive when you think about like a state program like this.
And that probably goes in to answer the next question, which was, has the uptick maybe been related to the recent interest rate increases? And so I'm guessing it probably has had something to do with that, but not taking away from the job that you guys are doing, which is obviously terrific.
I would say that is partial though. And really quick, there's other things that play into that. Number one, it's that more lenders are now aware of this program. So when you have more banks that are available and they see, oh, we might not have to deny this loan, there might be a alternative solution, that's allowing them to look at loans differently that they're coming in. So it's not only changing the landscape because of the rates environment being extremely high, which is true, but it's also that lenders are looking at how can they utilize this tool to either retain or keep the business that they have or get new business. And quick example, there was a bank a couple years ago that sent us a loan for an ice cream parlor. The ice cream parlor, the bank officer could see the ice cream parlor across the street from his office window. It was a staple in the community. And during COVID, obviously, it took a huge hit. And then after, it was very hard to kind of get back up and catch up. The bank policy could not do the loan because of COVID. The pro formas, the debt analysis was low. The collateral started to kind of go out. And again, they were operating so much in the red that the bank needed us. That was a situation where the bank's like, look, this is a staple in the community. We want to do this loan, but we just can't without your assistance. So that, just keep that in mind. I mean, that's really how the program's designed. And you can see all different types of like need, whether it's rates, whether it's, more volume, whether it's trying to save a business that you believe in. There's so many different. So I'll now turn back to you for the rest of questions, but I wanted to hit that a little bit more in depth.
One more before we jump over to a question about Invent. So how long does it take to complete the process before the loan is approved and funds are issued to the bank or the borrower, bank and borrower?
Okay, perfect question. I'm going to start with the last comment of that. We do not send any money to the borrower. All the money that we provide will go directly to the bank, but the bank would have already funded you. So I'm going to work this question backwards. So for example, if we approved a $100,000 loan, so the bank is $50,000 and we're $50,000, when you go close that loan with the bank, they're going to give you that $100,000. Then behind the scenes, we're then quote unquote, I have air quotations up, we then send the bank a check for our $50,000. We're reimbursing the bank, so to speak. So borrowers will never see any of the money directly come from our agency. Now, into the actual question about timing, I got to answer this in two quick answers. Number one, you keep in mind, we get the project after the bank has done their review. So I can't speak on how long a bank can do. How long they would take. A bank could take a week, they could take 2 weeks, it could take 30 days. But once the bank has done their process, then they send it to my team. From there, we do everything that we can to have our review process, our checks and balances, and then we have something called our committee where we present on all these projects to get final approval. We try to have everything done the best we can within 30 to 45 days. As I'm sure some of you can imagine, sometimes projects can come and be quicker than that based on, just the project. And in some cases, unfortunately, it can take longer to 45 days. But we're corresponding with the bank, letting them know about the timing, anticipation date of taking that project to committee, X, Y, Z. So it's not a great response to that question. I acknowledge that, but I would say realistically anywhere from 30 to 45 days, potentially maybe just a little bit longer.
Okay, thank you. Donna, here's a question for you. So I don't know if your program's been around long enough yet, but is the state anticipating a certain ROI on its investments in these projects, or have you been able to calculate one so far, an average ROI?
We are still too early to have that information, but I do want to emphasize that yes, we do want to achieve a significant amount of return so that we can keep the program in operation even after the Treasury funds are all spent. But there isn't a target that we're looking for because we also understand that the purpose of the funds is really to support founders that have lacked access to capital. So we're not requiring a specific expectation, but the goal is if we can get to a significant ROI, we can sustain the program.
Okay, good, thanks. Sean, back to another question about your program. So on retained jobs as a way to calculate job to dollar ratio, what does the business have to prove in order to claim a retained position?
It's a great question. So initially, one of our exhibits that you'll fill out will kind of talk about your employment impact. So you as that borrower, as the business owner, you're going to put in there either A, if you're going to create jobs or if you're going to retain them. If you're going to retain them, we like to see a little bit of context, maybe how many positions, well, we need to know how many positions first and foremost, but then a little more context on, how would this loan maybe modernize that? How would it help you retain those employees? Like things of that nature. But then going forward, we'll send a kind of a correspondence to you as the borrower after about your first year of having this loan as just a check-in. We'll come in, we'll say, hey, have you been able to create and or retain those jobs? And it's just a simple yes, no, or, some correspondence verbiage going back on why you couldn't retain them, what happened, but from there, that's all it is. It's just more of a conversation. Our guidance and rules set by U.S. Treasury is there's no clawbacks. We want people to be honest. This is not to be used to try to finagle the system to get a low interest loan. No, it's really to try to use in the right way for businesses that are struggling. Kind of with that being said, like I said, there's no clawbacks. We really do kind of expect and want that honesty method. So if you tell me you're going to create 5 jobs, and I'll talk about retaining in a moment. If you tell me you're going to create 5, and then a year I come to you and you say you've only created 1, well, I want to know what's going on with those other 4. Do you plan on creating those 4 in the next year? I need to know. And that's the same thing with retention. And flip it. If you say you're going to retain 2 jobs and I reach out to you in a year and you say you didn't retain those, I need to know why. I need to just understand so then I can just put in the file. But that's the end of it. We just have that context. Very simple.
Good, okay. Sounds very borrower friendly. Donna, here's another question for you. So how would a potential applicant go about contacting the state for this program? What would be their first steps to take to get in touch with someone if they're interested?
So any company that is interested must submit an expression of interest that is available through our website. So on our event page portion of the DCEO website, there is a tab that indicates submission, and there's a link there to submit the details. There is also a downloadable PDF that kind of summarizes all the questions because you do have to complete the form in one sitting. There is no way to save and return to it. And I want to mention too that there is a checkbox at the bottom of the submission before you submit where you can receive a copy of what you've submitted.
Thank you. Sean, this question's for you. So DCEO gave part of the funding to IFA for the climate related projects, and those projects can be a maximum of $2 million. Do you know how much money was provided? In other words, so we can get an idea of about how many projects they could fund, for instance, if everyone received the maximum, so to speak.
Sure. IFA, not everybody might receive the maximum. You would work with that team just on it, kind of understanding, what they would provide. Their program will be just a little different than ours in that aspect, where they might be doing a little bit more of countering with the lender, saying, hey, we can't go up to 2 million, we could only do, 1.39 or something, whatever it may be. So they're really looking at that particular project / risk a little bit more to see if they can, how they can help more businesses, but also become more sustainable and then self-solvent. So to answer that question, the first round of funding that the Illinois Finance Authority received was in the amount of $10 million. They will receive more, just the same as like Donna and I will receive, just more based on U.S. Treasury steps. But they'll receive $10 million now. They'll receive another $10 million later. And then from there, there's performance metrics where they can receive even more to build off of these businesses. But final comment, with these loans, they get paid back, right, by the borrowers. Obviously, you're taking out a loan, you're paying back the bank and us. That money goes right back in to be able to lend out to another business. So that's how some of these programs become a little bit more self-sustainable, is that you're able to kind of keep lending out what you're receiving back. So don't think that $10 million is a low amount, especially when we said their max is 2, because again, they're really going to look at it and see how they can help you out before they just look at a dollar figure.
Sure, understand. So with the Advantage Illinois programs, many communities have their own revolving loan funds. Is it acceptable for a bank to bring other resources to a project in that same way that they'd be bringing the participation loan? Maybe they bring in a revolving loan fund from the city that they're located in and start stacking those funding sources. And if that happens, then where does DCEO like to be in order of repayment on a loan like that?
That's probably the most difficult question so far, only because it is possible and it is doable, but there's quite a few things that need to happen behind the scenes. If you can kind of remember, Donna showed a slide about like a $20 million project cap. That's going to be the same thing for my programs as well. Total project cannot eclipse $20 million at all. So when you start talking about layering, bringing in other lending organizations or assistance, we got to really be mindful of that. That's first and foremost. But the second thing is, the reason why I say this is the hardest question so far is that's actually has to start the conversation between me and the lender. I need to understand what they're trying to do with that, like governmental agency or that kind of that loan fund. Are they looking to use it to help bridge additional gaps? Are they using it to help mitigate their risk? You see, so it's more of a conversation I need to have with that particular institution, because there's a caveat within Advantage Illinois that's set up for the borrower in mind, that at all times we are in a loan with the bank. That bank cannot basically they can't get rid of that loan. So they can't sell it off in the secondary market. So you as that consumer, you'll always know who your loan's with. You'll always know what essentially like what branch you originated that loan with. You'll know who your payments are going to. So when you start talking about bringing in other organizations, that then becomes into that kind of trickle down effect. We need to see how much the bank would provide or get from that third party. What would that do for us? Because the final comment goes into what you just said, Angela, of where would the state like to be, either in terms of like prepayments or subordination, like lien positioning. We're gonna have to talk to the bank about that. We like to be right behind the bank. So if they're at first, we like to be at second. If they're at second, we want to be at third. But there are times where the bank will be at 1, that let's say that local governmental agency might be at 2, and then we're at 3. It's all based on conversation and context of that particular project. So apologize, I can't answer that one any better than that for now, but happy to talk it out further if you have an example and or an idea or just more context.
Okay, thank you. I just want to ask if there are any more questions that Donna needs to address maybe hold your hand up or throw them in the chat. Otherwise, she's going to have to jump off the call. She's had an emergency. Don, I don't see anybody putting any in the chat, and I haven't received any in email. So definitely thank you for your time. And I hope things are okay on the other side.
Yep, just possibly an ear infection that I have to go pick up my daughter. But happy to answer any questions if you get them by email after the event as well. Thank you, everyone. And apologies that I have to jump.
Thank you, Donna. Shauna, I am getting a couple questions by text. One of them is, what are the reasons why banks may not want to participate in the Advantage Illinois programs?
I guess it could be all across the board. I don't want to give one response because it could be that banks maybe aren't familiar with the program. It could be that they prefer to do loans in-house. And either just like, hey, if we can't approve this loan, we're not doing it. Or third, there are SBA preferred lenders out there. So there could be lenders that just say, hey, we've used the SBA program for years. This is kind of our bread and butter, and we're going to stick to this. There's nothing wrong with that. The program was never designed to be a competition to the SBA, but those are probably the three up front. Honestly, years have passed. If a bank had a bad experience, maybe a loan that they wanted to get approved, maybe it wasn't. That's a hard question to kind of speak to. But the first three that I said are probably the biggest reasons. Maybe lack of knowledge or understanding of how this program works. Maybe they just prefer to keep them in-house. They're more of a conservative lender. Again, nothing wrong with that. And or three, maybe they just prefer a different financing tool than Advantage Illinois.
Okay. For those of us economic developers or chamber execs that are on the call, maybe there's something that the state can provide. And I know you have in the past, you've been strongly marketing this program for a while and using these navigators to help get the word out. But, maybe there's a one pager or something that we can use to help you market your program, to go to some of the lenders in our communities and introduce this program to them if they haven't heard about it, or refamiliarize them with it, or update them. Like, this has been so helpful for me because when I used to talk about these programs a lot, we just referred to them as the participation loan programs. It didn't come under the umbrella of Advantage Illinois. So there may be some confusion among people who've worked with them before that it's, really operating the same way the PLP is. The loan guarantee is a new tool, and maybe we can access some of that information in an easy one-pager sort of marketing piece that the state might have.
Yeah, we're actually in the process now of kind of revamping some of our marketing materials. And that's not as like a cop-out or anything. It's actually because the loan guarantee program has not been live yet. So this group actually is the first, I'll call them public group, that's heard this loan guarantee presentation. There have been banks that we've slowly started giving the presentation to, just to kind of plant the seed, say, hey, this is coming or forthcoming. But this is truly, this is the first public group that has heard this call. So I can send what we have now to you, Angela, and then you can maybe disperse it for some of the one-pagers we have. But honestly, we are actually revamping them, and we're working on creating one-pagers to kind of exactly what you're talking about, like a one-pager for a business, a one-pager for a lender, a one-pager for, let's say, a manufacturing association, one-pager for XYZ. That way, there's more directed points to be able to just like see high level. Oh, this fits me. This is exactly what I'm looking for. So more to come on that. And again, it truly is just because the loan guarantee program. We just got word from our legal team yesterday that the agreement for our banks to sign is ready to go. So that is, again, just to stress how new this program really, really is. So just kind of be on the lookout for some of that new updated marketing materials to be coming your way. But I think that would be great for you to be able to use not only for your own self, but again, as you're kind of out marketing, talking about it, whether it's to a lender or a borrower, you'll have something right there.
Okay, thank you. Cindy, I see that you've raised your hand, and I'm not sure that this platform gives me the ability to do anything about that other than maybe ask you if you've got a question, can you put that in chat? And then I can ask it. And back to another question that arrived, Sean. So you addressed this a little bit in your presentation. Why would a borrower, if they're talking to their lender about the PLP versus the guarantee, and they have a strong opinion, as the borrower, why would they want to be leaning toward one over the other? It sounded to me like in your presentation, obviously there's some fees up front with the guarantee program. Is it maybe a riskier borrower that the bank might be less inclined to finance, that the bank would steer more toward the guarantee? Or why, in your opinion, would either a lender or a borrower lean on one of those programs versus the other?
Sure. It's all going to be about that bank's particular policy, where your project fits within that, and how the bank can see a favorable approval for you. What I really mean by that is you saw or at least experienced that the meat and the bones of the programs are the same, but it's how they're operated, it's the funding, it's everything in between that is different because they're two different types of banks. It's really more for the lender to say, all right, this is what I need, whether, it could be due to lending limits from the bank or, whatever, but it's really a vessel for them that then would kind of trickle down to the borrower to say, hey, this is how I can get this loan approved. Otherwise, I can't. So it's not every situation may appear to be the most advantageous for the borrower. Like if you're sitting there saying, well, Sean gave this presentation and they offer the participation loan or the loan guarantee. Well, I want the participation because it's only 2% rate. The bank may say, we can't do that though because of X, Y, Z. So if you want that loan from us, you're going to have to do this loan guarantee. So it's more or less putting that back for like the borrowers to say, what you need for your business to be successful. So you're going to have to kind of take that moment and say, do I want to go try to find other banks? Do I want to see if I can find something different? Or this is delivered right in front of me. This is approved. This is what they can do, X, Y, Z. So it's more of that conversation, but it's a great question, but it's really more geared towards from the bank. And final comment, it's no different than if you go into a bank and say, hey, I got this loan, I need to do X, Y, Z, there's no guarantee they'd even send that to us anyways. Number one, they might be able to do it in-house without us. Number two, they might choose to do SBA. Number three, they might choose to do USDA. So there's never a guarantee that'll even come to my team. So that's why I'm saying, it really starts with you and the bank on what they can do and then how they can do it, if that makes any sense. Hopefully it does.
No, it makes perfect sense. And I think it's a testament to the programs and the way the state has set them up that you're just trying to be a catalyst and an additional resource to help a potentially already almost bankable project get off the ground, help that borrower access capital, create jobs or retain jobs without necessarily getting in the business of telling a bank how to do its job or how to evaluate its borrowers. So
that's right. Yep.
I think it's terrific. Well, there are no
Exactly.
more questions in the chat. I'm not receiving any more by text. So I think we can wrap this up. I want to again thank you, Sean, and obviously Donna, who had to jump off. I think the state's got some terrific programs for the potential business owners that are on the line or lenders that are on the line. I really like the idea of pulling off some of the funding and making it available for climate related projects at a potential 2% interest rate. I mean, that can maybe help get some of those off the ground, like you mentioned, for businesses that may want to add solar to their facility. And there are a lot of them that are talking about that. We're talking with manufacturers right now that are doing renovations and trying to talk about how they add solar panels. So hopefully there's some tools that you were not aware of or maybe had forgotten about that can help leverage some of these projects and move them forward. Also, I want to remind everyone that we do try to have these webinars on the last Thursday of every month. Thank you. We had an extra Thursday in February this year. Happy leap year to everyone. And next month's webinar will be about the Small Business Development Centers and resources that they offer, and the new Small Business Development Center that was awarded to this region that is housed at Elevate in Mattoon. So there'll be more business resources that you can learn about by attending that webinar. So thanks to everyone for attending today, and we hope to see you in a month. Thanks, Sean. Thanks,
Thanks,
Reese.
everybody. Have a great rest of your day.
You too.